Chasing the hottest small-cap fund or crypto trend might feel thrilling. But did you know that over the past decade, the Nifty 50 index quietly outperformed the average active large-cap fund by 1.3 percentage points per year? Yes, boring beats exciting in the long run. So what exactly is an exciting portfolio? It's one that's filled with small-cap or thematic funds, sees frequent trading, and chases big short-term gains. Think of funds that gave 17 to 18% annual returns, but with wild swings of 25% in either direction. And a boring portfolio? That's one that's anchored to broad, stable benchmarks like the Nifty 50 Total Return Index. It's well-diversified, low-cost, and focused on long-term compounding. Over the last 10 years, it's delivered a steady 11.2% CAGR, with far less volatility. Now let's talk data. First, active funds in India have been losing their edge. Over the past 5 years, active large-cap funds returned around 12.2%, while the Nifty 50 TRI gave 13.5%. That's a consistent underperformance of 1.3 percentage points annually. Even if you cherry-pick the top 5 active funds each year, your returns would only improve marginally, just 0.7 points more than the index. And you'd still take on more risk and effort. In a 10-year horizon, the worst-performing large-cap fund gave around 9%, while the Nifty 50 TRI gave 12%. That's the dispersion risk in action. There's no guarantee you'll pick the right fund. But why do investors still chase these exciting portfolios? It's behavioral. Overconfidence bias makes people believe they can beat the market by picking the right stocks or funds. Recency bias makes us pour money into whatever has done well recently, like mid-cap funds after a rally. And then there's FOMO, the fear of missing out. We jump into trending AI or small-cap funds after reading headlines, without considering the risk of a 30% drop in a single year. The truth is, consistency matters more than spikes. A simple, steady 11% return will double your money in about 6.5 years. No drama, no stress. And when you look at risk-adjusted returns, the story gets even stronger. The Nifty 50 TRI has about half the volatility of most small-cap funds. That means a smoother ride and better sleep at night. And let's not forget costs. The average expense ratio of an active large-cap fund is around 1.9%. For index funds, just 0.2%. Over 10 years, that seemingly small difference compounds and eats into your returns. So how do you build a boring but winning portfolio? Keep it simple. Put 70% into a low-cost Nifty 50 index fund or ETF, like the Tata Nifty 50 Index Direct Growth. Add 20% to Nifty Next 50 or Nifty 200 for a little extra return potential. And reserve 10% for debt or gold to keep things balanced and reduce overall volatility. And here's the most important part: rebalance once a year. No chasing fads, no switching every quarter. Let me leave you with this. You don't need excitement in your portfolio. You need excitement in your life. Let your money be boring and grow silently.